For the staple part of your investment portfolio, I'd agree with the consensus that a low-cost global index fund, which just tracks the world stock market as a whole, makes a lot of sense. If you back the philosophy that commerce will always find a way to succeed in some form, that the complexion of the world's most valuable companies might change over time, as trends and needs change, but there'll always be someone, somewhere with the ingenuity and foresight to spot that next trend or create it, and make a shed load of money in the process, then an index fund is the ticket. With a global index fund, you'll own a bit of that company, or those companies as they go public and rise to fortune. And yes, the big companies of the past will sometimes wilt and die off, but the new ones will make more money than ever before, and you'll have a little piece of that without even having to think about it. When it comes to picking index funds though, there are mistakes that people commonly make. You might think you've gained an exposure to the emerging markets, for example, with an emerging market tracker fund. But is that a FTSE or an MSCI tracker you've got? They're quite different things. There's more to it than just picking the fund with the lowest overall charge, because there are some factors that can make a far greater difference to your overall return than the odd hundredth of a percentage point. I'm going to break this down over the next few minutes so you can avoid these traps. And I'll also tell you the global index fund that I tend to use most and why. If you've landed here for the first time, I'm Chris Bourne, and for the past nearly 20 years, I've been helping people achieve tax-efficient financial independence. This channel is where I share my knowledge with you to help you hopefully do the same. So if that kind of content is interesting to you, don't forget to subscribe and turn on your notifications. With all that said, let's get into it. Index fund investing sounds pretty straightforward. You buy all of the funds in the index in order to simply track the performance of the market over time. How hard can it be? Well, operating an index fund is far more scientific than you might think. When money is flowing in and out of a fund in large quantities on a daily basis, things like the fund's dilution policy, which deals with the price assets are bought and sold at, its jurisdiction for tax purposes, even the valuation timing on a daily basis, all can have a big impact on your investment outcome. First things first though, it's important to understand what you're actually tracking in the first place. The two main global index providers you're going to come across are FTSE and MSCI. The fund you choose will usually tell you what it's tracking in its title, but it certainly will in the fund description on its fact sheet. Now each of these organisations offers a wide range of indexes, which group companies together either by geography, sector or size. The thing is though, they have different definitions of how those companies should be grouped and what is actually included in each index. That means that when you're trying to choose between index funds that you think are doing the same thing, you're comparing apples with oranges. The MSCI World, for example, is a developed market index, but FTSE World includes several primary emerging markets as well. MSCI Pacific ex Japan includes 4 developed markets, whereas FTSE Asia Pacific ex Japan additionally includes South Korea, Malaysia, Taiwan and Thailand. MSCI Emerging Markets has a 12% exposure to South Korea. FTSE Emerging has 0. What this means is that you could be trying to choose a world index tracker and comparing a few funds that from the name suggest they're doing the same thing. The MSCI ones though are investing into 23 developed markets and hold 1,512 constituent companies, whereas the FTSE tracker additionally invests into Korea and Poland, as well as 24 emerging markets, with 4,167 constituents overall. More companies doesn't necessarily mean better. It could be the opposite, because it could dilute your exposure to the companies that are actually driving growth. It's important therefore to understand what you're comparing. Similarly, you could be blending together different index funds and trying to get a balance between, let's say, more developed Asian markets with one fund and emerging markets with another, not realising that if you've chosen the FTSE Asia Pacific Index and the MSCI Emerging Markets Index, you've doubled up your exposure to South Korea. On the flip side, if you're tracking the MSCI Pacific ex Japan Index and the FTSE Emerging Markets, you'll have no exposure to Korea. All of this has an impact on the risk in your portfolio. Another area where people can be misled is in headline charges, and specifically the difference between annual management charges, abbreviated to AMCs, and ongoing charges figures, or OCFs for short. The AMC generally forms part of the OCF. Now, some index fund managers have a fixed all-in annual management charge, in which case the AMC and OCF are one and the same. But others have a variable OCF, where the annual management charge portion is fixed, but other costs that contribute to the OCF, such as custody, administration and legal fees, can vary. In this day and age, there's a lot of downward pressure on charges, but for all of the importance placed on costs by the media and consumers and the regulator, there is no mechanism to inform investors when an OCF increases for any other reason than the AMC going up. That means you could be told that a basis point or two is being shaved off the AMC to much media fanfare, and behind the scenes other costs have increased by more than what you've saved, so it's all smoke and mirrors. A basis point, by the way, is 1/100%. You'll see it abbreviated as BPS. We usually refer to them as BIPs. Take this data here, which shows that the charge on BlackRock's Emerging Markets Fund was as high as 0.25% in December 2018 and as low as 0.16% the following September. Or HSBC's Pacific Ex-Japan Fund, which was up at 0.25% in March 19, then down at 0.15% in December 21. Cost alone is often the basis that retail investors use for selecting a fund. So at any point in time, you could be choosing one fund over another, not knowing that the actual fees you're paying could be bouncing around all over the place over the next few years. And the fund that looked pricier initially might end up costing less. Another thing that's not widely understood is different companies' approach to dilution levy and swing factors. Now, this is a bit of a dry subject, and rather than go into it in lots of detail in this video, I'd encourage you to read more about it to gain a better understanding. And I've put a useful link in the description below. Even accounting for things like dilution levy though, there can be other entirely unexplained factors that create massive differences in the returns being provided by two funds tracking the exact same thing. This research here from Fidelity shows daily valuation differences between their US index fund versus HSBC's American index. And I couldn't believe my eyes when I saw that on one day alone there was a 4.9% difference in valuation. That's in a single day of trading. Fidelity was up on its competitor in that instance, but then down 3.3% in a single day, maybe 6 months later. The chart on the right though shows the cumulative effect of these daily valuation differences over a 9-year period, and it comes out to over 6% in Fidelity's favour. I guess this is Fidelity presenting the data, so they would want to show that. But when you think about 6% in relation to the odd few bips here and there in the headline charge, it renders those charges insignificant. I think that instead of overly fixating on headline costs, a far better way of comparing index funds is looking at their tracking difference and tracking error. These are measures of how far the index fund is actually straying from the index it's supposed to be tracking. And this should be published on a fund provider's fact sheet, which you can find through services like TrustNet and Morningstar. To be honest, there are lots of factors that can play into an index fund's performance. But before I tell you about the fund I tend to use personally, the other major factor I'd like to touch on is taxation. Now, as with anything in life, tax can make a big difference to the return you receive. You'd be forgiven for thinking again, though, that everything marketed to you in the UK is on a level playing field. But the tax domicile of certain index tracking funds is different. Many are UK based, but some are domiciled in Ireland or Luxembourg, and that can have a material difference on the return you receive. The most notable example is on US equity dividends, where tax is usually withheld at a rate of 30%. If the fund is UK based though, this is reduced to 15%, but Ireland and Luxembourg domiciled funds still pay the 30% rate. Similarly, on Japanese dividends, tax is withheld at 10% in UK-based funds, but 15% in Ireland or Luxembourg. It's just another important thing to be aware of and to check when researching different investment funds. So which fund do I use and why? I also want to say as well that this is not a recommendation of any sort. I'm simply sharing with you the fund that I use personally as a core part of my investment strategy. There are no affiliate links or incentives attached to this, and it's for information purposes only. You have to understand the risks of any investment or seek advice first if you're unsure. But with that said, I have for a long time held the Fidelity Index World P Share Class Index Fund as my favoured global index tracker. Now, the first thing that is attractive about the fund, despite me talking about the dangers of using headline price alone, is that it's very low cost, just 0.12% per year. But as we can see from this spreadsheet, that compares very well with its closest competitors. And the charge is fixed as well. The AMC and OCF are the same, and it doesn't bounce around. It's consistently displayed a very low tracking error over a long period of time against the MSCI World Index that it follows. It's actually produced a positive return above the index, which I think might be down to taxation and the lower UK withholding tax I mentioned earlier. But it's a very well managed fund that usually appears in the first quartile over all key investment time horizons. As you can see, there are lots of factors here that make choosing the optimum blend of index funds somewhat of a science. I'd say that this is one of those areas where good advice could be extremely valuable. It just comes down to access to information. Advisors will have access to systems that can provide this comparative data at the touch of a button, and those systems may not be available to retail investors, certainly not without significant cost, which just wouldn't stack up for individual research. That said, the information is out there. So by being aware of the factors I've mentioned today, if you're willing to invest the time, you can create your own manual process for comparing funds diligently. It must be said that although the investment strategy is very important, perhaps more important is how you structure those investments first to extract money in the most tax efficient way in the future. The video on screen now will help with that, so I definitely suggest watching that next. As always guys, I hope that's been helpful, and I'll see you next time.